All business come at some cost. It is quite imperative that it needs to be carefully managed. Financial management is concerned with optimal procurement as well as the usage of finance. For optimal procurement, different available sources of finance are identified and compared in terms of their costs and associated risks. Similarly, the finance so procured needs to be invested in a manner that the returns from the investment exceed the cost at which procurement has taken place. Financial management aims at reducing the cost of funds procured, keeping the risk under control and achieving effective deployment of such funds. It also aims at ensuring availability of enough funds whenever required as well as avoiding ideal finance. Needless to emphasize, the future of a business depends a great deal on the quality of its financial management. To ensure that all funds are deployed or utilized in such a manner that the returns exceed the cost. To ensure that there is enough security against funds procured by creating reserves, reinvesting profit, etc. To ensure that there are no ideal funds in the enterprise as they results in increased cost, lowering the value of addition. Let us discuss few prominent example of aspects which get affected by the financial decision. The size and composition of fixed assets of the business, the quantum of current assets as well as its breakup into cash, inventory and receivables. Third one, the amount of long-term and short-term financing to be used. Fourth one, breakup of long-term financing into debt, equity, etc. And the last one, all items in the profit and loss account. So, the size and composition of business assets depends on the financial decisions of a business enterprise. Over investment in fixed assets may block funds and increase the size of fixed asset, which may not be healthy for business. On the other hand, too little investments may hamper the growth of business. For example, a capital budgeting decision to invest a sum of 100 crores in fixed assets would raise the size of fixed asset block by this amount. And the second example, let me check second example. Increase in the investment of fixed assets will result in high demand for working capital, or longer credit period extended to debtors will result in block of funds with the debtors. So, in this example, the financial decision about investment in fixed asset, the credit policy, inventory management, etc. influences the amount of working capital required by a business enterprises. Okay, and next let us check one more example. Like long-term debts carry higher rate of interest payable for a longer period of time. This directly affects the profits earned by the business enterprises. The financial management takes a decision about the proportion of funds to be raised through long-term and short-term sources. If a business enterprise wants to remain liquid, it will raise more funds from long-term sources. The financial decision to raise funds from long-term sources adversely affect the profitability of the enterprise. Therefore, financial management has to make a choice between profitability and liquidity.